Let's move on and talk about the loanable funds market for a little bit. The quantity of investment in an economy is calculated as the amount of savings plus the amount of net taxes minus government expenditure plus the amount of imports minus exports. National savings is what is known as that private saving plus the net taxes minus government expenditure, and foreign borrowing is what is known as imports minus exports. The nominal interest rate is the number of dollars that a borrower pays and a lender receives in interest in a year, as expressed as the number of dollars borrowed and lent. As expressed as a percentage of the number of dollars borrowed and lent. The real interest rate is the nominal interest rate, but it's adjusted to remove the effects of inflation, and is calculated as the nominal interest rate minus the rate of inflation. The real interest rate is the opportunity cost of borrowed funds, because the real interest rate is paid on borrowed funds. Real interest rate is foregone when these funds are used to buy consumption goods or invest in new capital goods, and so that interest rate is not something that you'll get. That is why it's the opportunity cost of not saving or lending those funds. The demand for loanable funds is the quantity of loanable funds demanded, and the total quantity of funds demanded to finance investment, the government budget deficit, and international investment or lending in a given time period. The demand for loanable funds is the relationship between the quantity of loanable funds demanded and the real interest rate. But we have to hold expected profits constant. Let's say that Amazon is expecting $5 million from a $100 million investment. Will they decide to make the investment or not? Will this quantity of loanable funds be demanded or not? Let's take a look. Well, if the interest rate is greater than 5%, then the money that Amazon has to pay to whatever bank it's looking for is actually going to have to be over $5 million. So any profit that they get back is going to be used to pay that interest payment, and so it's not going to be worth it. So they will not demand this $100 million in investment. But if the interest rate is less than 5%, then they will, because we're going to be paying less than $5 million in this interest expense, and so we actually get to retain some amount of that profit. Ceteris paribus. As the real interest rate falls, we're going to see an increase in the demand for loanable funds, the quantity demanded of loanable funds. And as the real interest rate rises, we're going to see a reduction in the loanable funds demanded, the quantity of loanable funds demanded. When we talk about changes in the demand for loanable funds, we're going to see changes in the curves. We're going to see either an increase or a decrease. Anything that changes the expected profit will change the demand for loanable funds. Ceteris paribus. The greater the expected profit from new capital, the greater is the amount of investment, and thus the greater is the demand for loanable funds. But what changes expected profits? One of the things that changes expected profits is the business cycle, the expansions, the recessions. Expansions increase expected profit, and recessions decrease expected profits. Technological change will generally increase demand for loanable funds because it creates profitable new products. A growing population also increases the demand for loanable funds because we have an increase in expected future profits. You have more people, they're going to be buying more stuff, so you're probably going to expect an increase in the profits that you receive in the upcoming year. When we talk about consumer confidence, if consumer confidence in the economy is low, then businesses will have low expected profits. And if consumer confidence is high and consumers are going out and buying stuff, then businesses will expect higher profits. So the demand for loanable funds will increase. The supply of loanable funds, when we talk about it, we're going to be talking about the quantity first. So the quantity of loanable funds supplied is the total loanable funds available from saving, the government budget surplus, and international borrowing during a given time period. When we look at the supply of loanable funds curve, we're going to notice that it's the relationship between the quantity of loanable funds demanded and the real interest rate. And as the real interest rate rises, we have an increase in the loanable funds supplied, quantity of loanable funds supplied, and as the real interest rate decreases, we have a decrease in the quantity supplied of loanable funds. When we talk about a change in the supply for loanable funds, we're talking about an actual shift in the curve, and this rests on 4 factors, one of which is disposable income, which is equal to a house's income minus its net taxes. When disposable income increases, consumption expenditure does increase, but it's going to increase by less than the amount that the income is increased, because some of this income is saved, and this is what shifts the supply curve. The greater is a household's disposable income, the greater is its savings, and so supply would shift to the right. But if the household's disposable income decreases, then the supply curve will shift to the left because it doesn't have as much money to save. It also depends on expected future income. And we generally say that the higher a household's expected future income, the lower is its current savings. So the higher the expected future income, the greater the decrease in supply. And this happens because consumers gain confidence that, okay, our income is going to increase in the future, so we might as well spend now. What's the point in saving? We're going to earn that money back later. It also depends on wealth. The higher a household's wealth, the less their savings, and this is simply because, again, confidence. If anything happens to me, then I have all these assets that I can sell off and pay off my debt. So why do I need to save? It also depends on default risk, and default risk is the risk that a loan will not be repaid. The greater this risk is, the higher is the interest rate needed to actually induce a person to lend the smaller, and so the smaller is the supply of loanable funds. So, in essence, a greater default risk means a lower supply of loanable funds, and a smaller default risk means an increase in the supply of loanable funds. If the quantity of loanable funds supplied exceeds the quantity of loanable funds demanded, then there's a surplus of loanable funds, and there's downward pressure on the real interest rate. But if the quantity demanded of loanable funds exceeds the quantity supplied, then there's a shortage of loanable funds, and we have upward pressure on the real interest rate, until we reach an equilibrium. When we talk about an increase in demand, what happens? Well, we see a rightward shift of the demand for loanable funds curve. This, number one, increases the quantity of loanable funds demanded and supplied, and it increases the real interest rate. A decrease in demand for loanable funds has the exact opposite effect. We decrease the real interest rate, and we decrease the amount of loanable funds, quantity of loanable funds demanded and supplied at equilibrium. When we increase the supply of loanable funds, we see a decrease in the real interest rate, but we see an increase in the quantity of loanable funds demanded and supplied. So we see an increase in the equilibrium quantity. We see an exact opposite effect when we see a decrease in supply, because the quantity of loanable funds decreases, but the real interest rate rises.